Good morning. My name is Simon Fraser, the Executive Director of AusCham, and welcome wherever you may be on Zoom and Facebook Live in Vietnam or around the region. Our webinar today is brought to you by AusCham and ANZ Bank and discussing how Asia is coping with economic PTSD. I'd like to start by thanking ANZ Vietnam, who've been a strong supporter of AusCham over many years, the 23 years the Chamber has been in operation. And with the strong outlook for recovery, we look forward to an ongoing relationship for the future as well. Let me start by saying Asia experienced the worst recession last year since the Asian financial crisis. Early expectations of a strong rebound this year have been dashed by the resurgence in COVID-19 pandemic across the region, and also with the emergence of different variants. Post-traumatic stress disorder, PTSD, may occur in people who've experienced traumatic events. In our webinar today, Khoon will share how Asia is coping with the economic version of PTSD and also present his outlook for the Vietnam economy. Our speaker today, as mentioned, is Khoon, Head of Asia Research with ANZ. Khoon oversees and coordinates the Asia Economics and Strategy Research functions in Singapore. His particular area of focus is on Asia, macro, and currencies. He has over 20 years of experience working in various economic and strategy roles across both the public and private sectors. And prior to the pandemic, Khoon actively travelled to market ANZ's futures to investor clients such as central banks, hedge funds, and real money. As well as corporate clients, he also appears regularly in the media. And it is with great delight I welcome Khoon to our webinar this morning. Thank you, Khoon.
Thank you very much, Simon, for the introduction, and good morning to all of you. Thank you for taking the time to attend this webinar. So over the next 20-25 minutes, I'm just going to share with you how I see the economic outlook in Asia, and with a particular focus on Vietnam, obviously. As Simon said in the introduction, the world economy has gone through pretty much an unprecedented stress event in the form of the COVID-19 pandemic. In Asia, the economic damage has pretty much been unprecedented. In some economies, the hit to growth has been far worse than what was experienced during the Asian financial crisis. This table here on the left just highlights the low point in terms of the GDP year-on-year growth last year, and you can see the worst hit economies were India, where the economy suffered almost 25% contraction in GDP growth year-on-year, pretty much unprecedented in recent times. Now, Vietnam did fare a lot better, as you can see on the table there. Vietnam managed to avoid an outright economic contraction, posting modest growth, but still positive nonetheless. Now, the global economy in Asia in particular has managed to post a recovery from the middle of last year. But as you can see on the chart on the right, the recovery so far hasn't been strong enough to fully recoup the lost output for some economies, and more importantly, we still remain well below where we were in terms of the pre-pandemic trend for growth. And my expectation is that while we can expect further recovery, it's just going to be a long, drawn-out process, and it might take several years before the Asian economies can get back to pre-pandemic trend, which is that orange line you can see there on the right. This is partly due to just the nature of the impact of the pandemic. Unlike other types of economic shocks, this particular shock is largely a health crisis that morphed into an economic crisis, and different sectors have been impacted very differently compared to past recessions. So over the next section, I'm just going to go through, what type of PTSD that we are experiencing. Now, obviously, PTSD is a form of stress that individuals go through. In terms of the economy, I'm just going to focus on 4 types of PTSD: pandemic, tapering, stagflation, which is a rising concern amongst investors, and finally the big D, which is debt. And this is something that is currently quite topical, particularly in regards to China, with the second largest property developer getting very close to a potential default. Now, the first P, pandemic. We are now moving into a post-pandemic world, and there is very, very clear now that there's no way to get rid of the virus. In fact, currently around the world, I think there's only about 2 countries left that are still currently trying to pursue elimination or zero COVID strategy, which is New Zealand and Hong Kong. All other countries have pretty much given up on that, and including in Singapore, where I live. So we are very much now moving to a post-pandemic or learning to live with COVID environment. Now, I think one of the things we need to recognize is that, whilst it's still challenging right now, and Singapore, for example, is still recording the highest COVID cases on a daily basis. Vietnam's case numbers are still high, although it's starting to show signs of peaking. Eventually, the peaks do actually start to come off. And as you can see from the chart here on the left, back in May, India was a major source of concern, where COVID cases were hitting almost 500,000 daily. But through a combination of lockdowns and other types of measures, they were successful in eventually bringing their case numbers sharply lower. Indonesia also experienced a very nasty outbreak back in July, August, and they too have managed to bring their case numbers down. And we're starting to see in other countries in Southeast Asia, like Malaysia and Thailand, their case numbers have also looked to have peaked, and they're starting to come down. So I think the strong message here is that given outbreaks, eventually they do come down. A combination of lockdowns and other types of restrictions are effective in bringing the numbers down. However, that in itself is not enough, because eventually you can't lock down forever. Economies need to reopen, and that's where you have the potential for another wave coming up if you do. So vaccination is really a key part of the strategy of learning to live and cope with COVID. Now, in this regard, in this part of the region, Singapore is the most advanced in terms of vaccination. Over 80% of the population now is fully vaccinated, which is why Singapore government has the confidence now to start to gradually reopen. And even though case numbers are at record highs now, there is no inkling that the Singapore government wants to go back to the tough lockdowns that we have endured in the past. Now, other countries in this region are also at varying stages of opening up, but a lot of that is tied to the progress on the vaccinations. The threshold that most governments now look to be identifying is about 50% for fully vaccinated population in order for them to start to gradually open up. And I think there's a recognition now that trying to get the full population towards at least 80% vaccination is the minimum requirement to have greater confidence to carry on with further broader opening up of the economy. That way, while you can't eliminate infections, you can at least lower the number of severe cases such that the health system does not get overwhelmed. So that is really the strategy now of learning to live with COVID, or moving to the endemic phase. Now, if you look at the vaccination progress across Asia, as I mentioned, Singapore is the most advanced. China is actually catching up to Singapore with their vaccination rates currently very high. Now, Vietnam at this point is towards the bottom end of the scale, but progress is being made. As vaccinations ramp up, we should start to see the vaccination percentage of the population who are vaccinated rise quite rapidly. Now, I mentioned around the 50% level. Quite a few countries have already achieved that, but really is trying to get towards that 80%. that is going to be critical. So for some of the Southeast Asian countries, it's probably not likely to reach that level until sometime in 2022. They'll depend on things like supply from key providers. It also depend on the extent of vaccine hesitancy. Although I think personally there's probably lower vaccine hesitancy in Asia compared to other Western countries. So I think that's not going to be an issue. It'll be more the supply and the logistics in getting the vaccine more widely available, particularly towards the more rural or hard to get to places for some countries. Now, in terms of the next one, T, tapering. And this is starting to become quite a key focal point for markets recently. Tapering refers to the US Federal Reserve's decision to eventually start to wind back the unprecedented policy stimulus that they have provided the US economy. And Fed policy is very important, not only for the US economy, but for the world as well, because the US sets pretty much the benchmark interest rates that the rest of the world follows. And US monetary policy does have a very, very important bearing on the US dollar, and therefore has a huge influence on how currencies and broader risk sentiment fare. Now, the US economy has actually been rebounding very strongly. Inflation is high and well above the Fed's 2% target. The labor market is improving, and it is getting close to the point where the US Federal Reserve is getting ready to wind back their asset purchases. Tapering, we believe, will begin before the end of the year, probably either in November or December. Now, markets and investors in particular still have terrifying memories of what happened in 2013, which was the last time the Fed embarked on tapering. It was widely known as the taper tantrum, where a surprise announcement by Fed Chair Ben Bernanke then, that the Fed was getting ready to taper, caused huge market volatility. The US dollar strengthened, US interest rates rose. Emerging markets in particular came under a lot of stress as investors sold risk assets. Currencies came under a lot of pressure. And therefore, that's why investors are now keeping a lookout as to whether or not we're going to see a repeat of that. Now, my very strong view is that this time around, we are going to avoid a taper tantrum type scenario in Asia. The key reason for that is the broad macro fundamentals now in Asia are very different from 2013. Yes, we're still grappling with the effects of the pandemic, but there are some key differences between now and then. Back in 2013, a lot of Asian currencies were actually trading rich, or they were overvalued at that stage. Also back then, some of the badly hit economies were running large current account deficits, in particular India and Indonesia, which is why they got hit far worse than the rest. This time around, if you look at the current account balances, the chart here on the left, Asia's current account surpluses have actually vastly improved. Even the badly hit countries in 2013, India and Indonesia, have seen a remarkable turnaround in their current account surpluses. Indonesia, in fact, look on track to run a current account surplus this year, which will be the first time it has done so since 2011. So having a stronger external position where current account surpluses are either strongly positive or less negative is a very important buffer that will prevent Asia from succumbing to the types of volatility that we saw back in 2013. I think another very important defense mechanism for Asia this time around is the huge build-up in FX reserves across the region. As you can see here from the chart on the right. Now, China's FX reserves are still very large and formidable, but the rest of Asia has really built up their reserves to a level where now it's very, very adequate and large enough to be able to defend their currencies should there be any market volatility. India's FX reserves have almost doubled from 2013 levels. Vietnam's FX reserves continue to build up, now exceeding $100 billion. So this provides very, very important insurance, I guess you can put it that way, towards market volatility. And again, that's a key reason why we don't anticipate too much volatility when the Fed eventually comes to taper towards the end of the year. The next thing that investors are keenly focused on at the moment is the S word, stagflation. As I mentioned earlier, in the US, inflation has risen above the Fed's target band. But it's not only in the US that we've seen inflation rising. We've seen inflation pressures emerging pretty much right across the board. And this is coming from not only a low base, because inflation fell last year and therefore it's playing catch up. We've also seen supply chain constraints, supply disruptions, which has pushed prices higher as a result. Commodity prices are also very high, not only oil, but also food-related commodities as well. So that's feeding through into inflationary pressure on basic necessities like food as well. House prices, asset prices have also risen, and that's also imparting some form of inflationary pressure through that channel as well, particularly through into owner-occupied dwellings or residential construction-related activities. So high inflation is definitely an issue that policymakers are starting to focus on. Now, stagflation comes from a combination of high inflation and low growth. And once again, this is where the growth concerns, particularly around the impact of the pandemic, the Delta wave, slowing down activity, is an added element of concern for investors. Now, my view is that stagflation is not an issue that will come to reality. Yes, the world is grappling with a little bit of a high inflation pressure at the moment, but my view is that some of these inflation pressures are temporary. I believe that eventually the inflation pressure will subside, especially as we head into next year, because the base effects will become less onerous. Also, you can see here on the chart on the left, this is a chart of Asia's inflation on average versus the key commodity prices, in particular oil and agricultural prices. And you can see oil and agricultural prices rose very strongly this year, but inflation in Asia has gone nowhere near where commodity prices have been. I think this is due to a combination of the fact that some of the prices in Asia, particularly for basic necessities, are still controlled. So therefore, we don't get the full pass-through. In addition, Asia has had many years where central banks have, through inflation targeting, managed to bring inflation expectations under better control. So we're not seeing cases where inflation is starting to get out of hand. And as oil prices eventually settle down, and they have started to settle down at current ranges, therefore we're not seeing a further increase in price gains. So this stabilization in oil prices eventually will lead to a fading of price pressures. So once the economies and businesses get used to oil prices around current levels, there might be further adjustment in prices to come, but this is not going to be an ongoing adjustment where they need to keep adjusting it every single month or quarter. Eventually it will settle down, and that's where I anticipate inflation to also start to settle down at a comfortable range within most of the price targets that central banks have set themselves. Now, in terms of the growth concerns, clearly there are huge growth concerns at the moment due to the impact of the pandemic. But eventually, once we get past the worst of the pandemic, and once vaccinations rates pick up and economies start to reopen, then I have confidence that we will start to see economic recovery rebound more meaningfully. We've seen that in other countries, for example, in the US and Europe, where they are now opening up and almost fully reopened, and we've seen how activity has managed to rebound strongly. So I have no doubt that in Asia, we will start to see that coming true as well. But it's probably going to be more like a 2022 story, just because of the slower progress of vaccination, as I mentioned earlier. One of the key supporting factors for growth in this region is the fact that financial conditions overall are still very stimulatory and very supportive for growth. As you can see here from the chart on the right, this shows growth in Asia. I've taken out China and India because they are they're quite big and they can swarm the numbers. But growth, you can see, has recovered already, and financial conditions are very, very supportive of growth, which tells me that once restrictions come off, the financial conditions can really help activity blossom and rebound. So stagflation concerns is not something that I am too worried about at present. And the final one on PTSD, which is D, debt. Governments around the world have imparted large fiscal support last year, and that has required taking on huge amounts of additional borrowing. And it's not just governments that have piled on debt. Households and corporates as well have added on their debt load just to see themselves through the challenging period of the pandemic. As a result, we've seen total debt levels in countries across Asia rising to pretty much unprecedented levels. Now, at some point, that debt has to be managed, has to be repaid. There's growing literature that suggests that government debt above a certain level can actually start to hinder and slow down economic growth in future. And we've already seen central banks in some regions starting to worry and express concern about rising debt levels because that might cause financial stability risks. South Korea was the most recent one where their central bank actually hiked rates in August, in part because they were worried about financial stability risks of having interest rates too low and how that is encouraging too rapid a buildup of household debt levels. That is something that is going to increasingly be a feature, and the current concerns around China Evergrande, which is the second largest property developer in China, I think highlights the negative impact that heavily indebted corporates can have on activity and the potential spillover effects if the company is too large and it starts to cause strains. Now, across Asia at the moment, in terms of government debt, we don't have too much concerns about it. Thankfully, most of the governments in this region entered the pandemic with reasonably conservative debt levels. And even though the debt load has increased as a result of the pandemic, they are not at levels that are alarming. They're averaging around 60% of GDP level. And typically, debt levels for governments need to get towards 80 or even 100% before they start to have some impact on economic activity. So we are not quite there yet. It's really the households and probably the corporate sector debt levels that we need to pay more attention to. Now, at the moment, due to what we call regulatory forbearance, or many economies across the regions have loosened up a little bit on debt to help out businesses and to ensure that bank NPLs do not rise too much. That has allowed the corporates to carry heavier debt burdens at the moment without having too much of an issue in terms of repayments or breaking of covenants. But of course, these types of regulatory forbearance cannot last forever. At some stage, debt moratoriums have to be lifted, interest payments have to be made, debt has to be made good. And this is where the economic cycle, how quickly the economies rebound, will be important in how these companies can then start to manage their debt burdens. So I think this is definitely an area to watch, because it could be an area that could become more of an issue, particularly for certain sectors, particularly for sectors that will be slow to fully recover from the pandemic. And I think we are quite well aware of which sectors that are. anything tied to hospitality or tourism will likely be the last to fully recover from the pandemic. That's because borders are still closed, and any opening up to international tourists will be gradual and will probably take quite a long time. So therefore, a full normalization of international travel is still quite a few years away, which means companies and sectors that are exposed to that will take much longer to fully recover, and particularly those companies that have excessively high debt burdens, that's where the challenge really will fall. Now, turning now to Vietnam's economic outlook specifically. Vietnam, as I said, had managed the pandemic last year extremely well. The economy managed to avoid outright negative contraction in GDP growth. It rebounded in the second half of last year very strongly, but then it got hit with a very nasty pandemic wave this year, which resulted in lockdowns across the country, and that really severely impacted on domestic demand. Not only that, but some of the key manufacturing hubs have also been affected, with production having to be curtailed to try and curb the spread of the virus. So a lot of recent indicators coming up from Vietnam has shown a very, very sharp contraction in activity. Chart here on the left shows Vietnam's manufacturing PMI and the sharp fall that was experienced in recent months. And that's telling us that economic growth in the near term, particularly in the third quarter, is definitely going to be very badly hit. The chart on the right here shows the average mobility as compiled by Google, and the fall in mobility was very severe, down around close to 70% below baseline or pre-pandemic levels, far worse than what was experienced back in March, April last year. So this severe contraction in mobility suggests that domestic activity pretty much almost ground to a halt. Again, that's going to result in a sharp contraction in economic activity in the near term. But you can see mobility has started to recover off a very low base. And I'm hopeful that, as Vietnam's vaccination progress continues, if the case numbers continue to go down, then that will allow for more improvements, more easing off of restrictions, which will see the start of a normalization of activity. For now, though, our economic activity tracker, which is shown here on the chart on the left, has indicated that Vietnam's economy has contracted for 4 consecutive months now on a month-on-month basis. And it's too soon to tell whether the current month in September will see a turnaround or whether we'll still see another month of contraction. So there's no doubt Q3 GDP growth will be severely dented. But once again, overall broad financial conditions for Vietnam still remain very positive, as shown here on the chart on the right. This is our proprietary financial conditions index for Vietnam. So once lockdowns can ease and businesses can start to get back to, I guess, the start of normality, that should signal a strong rebound in growth ahead, most likely towards the end of this year, but certainly into 2022. Again, everything hinges on the progress of the vaccination and how quickly the current infection numbers in Vietnam can start to come off. So near term is still challenging, but it looks like we might be getting close to the worst in terms of the economic damage, and we are hopeful that we can start to see the early stages of a rebound. Now, over the longer term, still very, very positive on Vietnam's medium to longer term growth prospects. What we are experiencing right now is our near-term challenges, but that hasn't changed the overall positive story that Vietnam offers. Vietnam remains very much a magnet for foreign direct investments. I think multinationals will continue to see Vietnam as a very attractive place to continue to invest. Now, inward FDI into Vietnam has slowed last year as a result of the pandemic, which is no surprise. But I see this slowdown as temporary, and I believe we will start to see a big pickup into 2022. Once the current pandemic wave comes under better control in Vietnam. And I think another positive longer-term development in favor of Vietnam, particularly with the supply chain shifts and something that we'll see further FDI going into Vietnam, is the free trade agreements that have recently been signed in this region. We have two major free trade agreements here, the RCEP, or Regional Comprehensive Economic Partnership, and the CPTPP. And Vietnam is signatory to both of these agreements, which puts it in a very, very good position. In addition to that, we now have the UK and China recently seeking to join the CPTPP as well. And if both of them are successful in joining, that will definitely make the CPTPP the largest free trade agreement in the world, covering a huge proportion of the world GDP and world population as well. And once again, I think Vietnam is actually very, very well positioned within that to continue to attract manufacturing FDI flows and capture shifts in supply chains towards its favor. Finally, I think another important positive factor for Vietnam is its demographics. Now, Vietnam is no longer that young. The median age is now, hitting in the 30s. But Vietnam is still set to cash in on its demographic dividend. It's now in the late stage of the demographic dividend. It's got at least, couple more decades where they can continue to make use of a fairly young labor force and growing working age population to sustain high economic growth rates before aging starts to kick in from probably the 2050s onwards. So Vietnam is still in a very good stage to take advantage of that. So a combination of ongoing FDI inflows, very attractive climate for business, free trade agreements with many important economic actors in the world will continue to make Vietnam very, very attractive place to do business, and hence help to propel its strong growth for years to come once it gets through this current very challenging period. And finally, this is just a table of our current growth forecast. I won't say too much about that. I think this will probably be made available to you after the webinar, so feel free to take your time to have a look at it. So that's the end of my formal presentation part. Thank you very much.
Thank you, Khoon. And thank you very much for the very comprehensive report that you've shared with us as well. I guess we have quite a few people online, and there are a number of questions. I'm not sure if you can see the Q&A box there on your side, but I guess would it be fair to say the takeaway from your report today would be that there's a strong focus on the need for vaccines to obviously progress the recovery of economies in the Asia region, and also I noticed the stats on mobility as well. So I guess the two actually go hand in hand. Would that be fair?
Exactly right. There's basically no other strategy apart from just getting your vaccination rate high enough to give yourself confidence to open up and let economic activity normalize. And really, that's the only way to, if you like, learn to live with COVID. So I think part of this, apart from vaccination as well, I feel that part of it is also a change in mindset as well that needs to happen. I mean, throughout last year, the whole world was worried about COVID and the fear of the unknown. But we are a year and a half into this now, and I think we have a much better understanding of the virus. Yes, there are still new variants coming up, And the Delta one that we're dealing with right now is more transmittable than the Alpha variant last year. But what we also know is that thanks to vaccination, you can still get infected, but at least the chances of you developing severe symptoms or potentially dying are significantly reduced. So this is an important part of eventually looking at COVID as just another flu, a nastier version of the common flu. But people every year die of the flu. For example, in Singapore, every year, around 600 people die of the common flu. They are largely elderly people with underlying conditions. So far in Singapore, under 70 people have died from COVID-19 so far. So again, putting those numbers in perspective, if we have gotten used to living with the common flu, and 600 people dying from the common flu is an okay risk to take, I think that's how we should start to think about COVID as well. I think we're not there yet, but hopefully with more understanding of COVID and better vaccines, I think we'll eventually get there.
So looking at the figures that you presented today, I'd say that there's probably a fair bit more confidence in recovery than there may have been in 2013 with the Asia financial crisis. Would that be a fair comment, or that they can't be compared?
Those are very different shocks, obviously, but I think this time around, now that we are getting a better understanding of the virus with the vaccine and the progress on the vaccination rates, I think there's greater confidence that once you start to open up the economy, activity will start to normalize. Because what's really holding back economic growth and why economies went through the worst economic recession last year was because governments basically stopped businesses from operating. That's what caused a massive dislocation in economic activity. Now, once governments allow businesses to operate, this is the reopening, then I have no doubt that you will see activity rebound.
I think we're going through that phase at the moment. So compared to some other Asian countries, we might be a little bit slower, but I think we're doing, the government is doing a fairly good job considering everything with the variants that we're tackling at the moment as well. So there are a number of questions in the Q&A. In the Q&A box, which I'd like to share with you, and it's one of the questions is, what is your outlook for the Vietnam dong currency in 2022?
Yeah, so dong is a very interesting one. Obviously, it's very carefully managed by the State Bank of Vietnam, but it looks like the way that the State Bank of Vietnam is managing the dong has changed this year. And this comes on the back of the agreement that SBV has made with the US Treasury. The US Treasury, end of last year, designated Vietnam as a currency manipulator. That was towards the dying periods of the Trump administration. That currency manipulator label was then removed under the Biden administration, but nonetheless, the US Treasury continues to monitor very closely what SBV does in regards to the exchange rate. The US Treasury still feels that the dong is undervalued and would like the dong to be more flexible. So the agreement that was reached between the US Treasury and SBV a few months back, I think was very important because that heralds a change in the way the dong is being managed. So rather than allowing the dong to be pretty much almost fixed, the SBV is now allowing the dong to be more flexible. And given that we are still seeing very strong FDI inflows into Vietnam, and even though recently the trade surpluses have turned into small deficits, I have no doubt that once the exports fully recover, large trade surpluses will be recorded again. So all those are very supportive for the dong, and SBV now is allowing the dong to reflect that. So if there's going to be bouts of inflows, they will allow the dong to strengthen, and they will not intervene as much in the FX market. So I anticipate that we'll probably see further modest appreciation of the dong heading into the end of this year and over the course of 2022, especially as Vietnam opens up. Once they get the vaccination rates up, manufacturing production picks up, pace, exports start to revive, the FDI flows, which have sort of halted recently, start to pick up again. I think those will be very, very positive forces for the dong.
Yeah, I think that it's interesting you've mentioned FDI through the presentation and now with your response to the question. It's I think people would be aware that over the past month or more, there's been comments in major newspapers from around the world about Vietnam perhaps missing out on the FDI because of the way that the pandemic is travelling in Vietnam. I think that would it be fair to say that that is just a slowdown and there will be some sort of recovery in the short term in FDI?
Yeah, so I think it's temporary in my view. After all, there's been significant investment that has already been made by many multinationals in Vietnam. And the longer term prospects for Vietnam remain very, very strong. So the pandemic obviously had a temporary effect. I mean, factories had to be shut or production had to be curtailed. But once you get the vaccination rates up, once you reopen, then the narrative for why these companies came to Vietnam in the first place hasn't changed. So I think that will encourage the FDI flows to resume again next year.
Yeah, I think that if anything, sometimes they're just opportunistic headlines. If anything, grabbing attention. But I think what I've seen over the past 12 to 18 months or more is the government asking for a speed up with the disbursement of FDI funding. So, I think that, as you mentioned, a lot of companies, their outlook for the future is strong and they've already planned to enter the country. So I don't think that a lot of the headlines are really that accurate. That'd be a fair comment.
Yeah, look, I think when you have the pandemic wave like what Vietnam has experienced and you had these big lockdowns and factories having to curb production, it's very easy to be pessimistic. But as I shown earlier, I mean, many countries like India, Indonesia have been through far worse pandemic waves. They managed to bring it down. And now, no one's really talking or worrying too much about India. It was a very different story back in May. So it's going to be the same situation with Vietnam. Yes, we're worried about it, or multinationals are worried about it at the peak. But once it passes, no one's going to bat an eyelid. No one's going to be talking about that anymore.
Yeah, I'd agree with you too, Khoon. I have a question from Michael Hayes. He's in Da Nang. He said there's a lot of big hotels that are now closed in that area, that part of the country, obviously on the mid-north coast. Do you see any improvement on the situation for the investment in a lot of the big hotels? I think that's probably relative to what you were talking about with tourism before as well, because obviously over the past, I guess even up to 10 years, there's been a very steady increase in investment in this area and also reliance on it to actually build the economy.
So this is one area where there's still a lot of uncertainty, obviously, because it hinges pretty much on how quickly borders can reopen and how quickly international tourism can resume. Now, at the moment, it's fair to say that as economies reopen, the initial bounce for tourism has to come from domestic tourism first and foremost. You have freer flow of people within the country. I think when it comes to international tourists, it's still very tentative at this stage. Thailand, for example, experimented with the Phuket Sandbox concept in July, where they opened up Phuket and a few other surrounding islands for vaccinated international tourists to come in. It's fair to say the take-up has been, I guess, below expectations. And Singapore, for example, now has just started quarantine-free travel lanes to certain countries. So you can see how countries and governments are starting to open up, but on a very gradual, on a very measured basis. No one is throwing open their borders up overnight. So as a result, I think the tourism sector recovery, unfortunately, will be slow going. It will rely on pretty much bilateral negotiations between countries in terms of whether they allow quarantine-free travel, etc. So look, I'm not pinning great hopes on a massive revival in tourism next year. I think there will be some. It's going to be gradual and really depends on which markets are fully open up, and again from the customer's point of view, how comfortable they are to travel and have a holiday in a particular destination as well.
Yeah, my opinion would be also aligned with yours, is that, as you mentioned earlier, that domestic tourism would probably be the leaders. And that'll give obviously the people in the government an opportunity to, I guess, I don't know if the word experiment is maybe a good word, but to see how we can actually operate under the domestic system before we're offering any international travel, I guess. So I have another question from Kevin Poynton. Do you anticipate any major structural changes across the region between countries, such as major relocations of industries or sectors from one country to another?
Well, the supply chain shifts that I mentioned, I mean, that's not new. That's been ongoing for quite some time. And the US-China trade war that started in 2018 obviously helped to accelerate some of that shift. I think there are potentially two major ones that could have a bearing on, I guess, the nature of FDI flows going forward. One is around climate change. This is increasingly starting to become very relevant. And it doesn't matter whether you believe in climate change or not. Ultimately, business decisions, investor decisions are increasingly now being driven by climate considerations and increasingly ESG considerations as well. So, and we've seen cases where climatic events have increased in their nature, more floodings, more natural disasters. So when it comes to picking a place to put in expensive long-term FDI, I think those factors will become increasingly important as well. So I think that's going to be an interesting driver for future FDI, which is something that hasn't really featured that much in the first place. The other one is around supply chain diversification, which increasingly now is also being tied to politics as well. Again, starting from the US-China trade war, but now with the increasing, sort of tensions around technology competitiveness between US and China as well. That's becoming more and more to the fore as well. So diversifying supply chains, making sure that no company is too reliant on one or two suppliers, because it can really stuff up the whole supply chain as we are seeing right now. I think that will also determine how companies spread out. So what that means is you'll probably end up with more of a splitting of sites of production bases. So again, that offers both a threat and an opportunity as well for countries as they vie for FDI funds.
Sure. So from an Australian investor's point of view, have you seen any changes in, say, FDI or movement of companies around the region, probably relative to the trade disputes between China and Australia as well?
Actually, we haven't really noticed too much in terms of the actual investment flows, right? We have definitely noticed the shift in the trade flows, obviously, like, Australia can't sell wine into China, they're selling it to other markets, for example. So we've seen trade flow shifts. In terms of the actual investment flows, I think coming from Australia anyway, we haven't actually seen much notable shift. We have seen a shift though in increased FDI coming out from China into the region. So again, once again, if you think about the last few decades, when China was opening up, there's a lot of FDI going into China, obviously, to take advantage of its large workforce, etc. But now we're seeing a shift now where Chinese companies are, because now they've grown to enough of a scale, and some of the Chinese companies do have global ambitions. They are starting to shift their production out of China into Southeast Asia as well. Again, part of that could be diversification. Part of it could be to reduce the political risk. If, for example, US were to impose, trade barriers against China, then it's easier to shift products out from Southeast Asia to US, for example. So again, these things are starting to become a feature in how FDI flows are, being made around the region.
Good. I have a quick question here for you, related to the State Bank of Vietnam. How do you see, what is your forecast for the State Bank interest policy in 2022?
I'm expecting the SBB to keep rates pretty much on hold throughout 2022. There's no real urgency for them to tighten rates. I don't think there's a need for them to cut rates either, because there's the issue that is facing the Vietnam economy at the moment is not because interest rates are too high, it's just because of the pandemic. But by the same token, there's no rush for them to be lifting rates in 2022 as well. I think possible rate increases might start to come to the fore more in 2023, and that will be when we start to see the US Federal Reserve probably starting to hike rates as well. So probably there's a need potentially for SPV to keep up with the Fed in that regard.
Great, thank you. I have, there's a couple more questions for you as well. It seems there's a positive outlook for Vietnam in the long run and for recovery. What key factors or sectors do you think will help Vietnam rebound in the future? And how do you see manufacturing? Have you seen any manufacturing move out of Vietnam due to the lockdown? So it's a two-part question.
I think what we need to think about in terms of the manufacturing and the supply chain shifts in Vietnam is that ultimately Vietnam is not a very large economy, about 100 million population, especially when you compare to China or even India. So we talk about supply chain shifts, but no one economy can really replace the manufacturing capability of China. Now within Vietnam as well, Vietnam is, prior to the pandemic, the Vietnam economy was effectively almost operating at full capacity anyway. So, and for Vietnam to move up the value-added chain, which is something that it should, we need to recognize that the lower-end manufacturing eventually needs to cease or move out to other places to free up resources, particularly workers and capital, to move up the value-added chain to higher-end manufacturing, electronics, etc. That's how economies continue to grow rich and sustain strong growth. So in terms of thinking about this manufacturing shift, what we want to see in Vietnam is more of the higher-end electronic value-added manufacturing shift into Vietnam, and the lower-end ones, which traditionally has tended to be in things like textiles and garments, need to shift out into other countries like Cambodia or Laos. So I think this is a very natural type of progression. The most important thing is we don't stop that, because that's what's needed to continue to revive and make Vietnam more competitive. And as long as the education system can keep up, and Vietnam can continue to produce the workforce that is able to be adaptable, and more importantly, function with a higher value-added manufacturing technology that comes in, then that's how Vietnam can continue to sustain growth of 7% plus and move into the middle upper income range in the next couple of decades. I think another factor as well is more of a shift towards services as well. So again, that's something we notice with economies as they move up, as they grow richer. There has to be a increasing development of the services sector as well, because that's again another important part of how an economy continues to move up the income bracket. And I think I will say one other thing as well. While at the moment Vietnam is reliant on MNC and FDI going in, it's also equally important for Vietnam to start to develop their own what we call national champions, or domestic companies that can be a vital part of the supply chain domestically to the multinationals, but eventually on their own right, start to manufacture and exports to the rest of the world as well. I think at the moment it's still early stages for Vietnam, but I think that's another critical area to develop.
I totally agree. I think that the government has actually been making all the efforts towards moving the economy in a more technology-based workforce, and we've seen this also with the service industry here in Vietnam through AusCham as well. A lot of inquiries coming through those two areas. So you know, it's understandable, and I think that's reflective of obviously the penetration of smart technology and also young workforce. So, I mean, that only probably heightens the possibility of a quick recovery as well in the future. I guess post 2023, at least anyway. Not being too hopeful for technology and services to increase all that much in 2022. Would that be fair?
This year, I mean, there are enough challenges as it is, but I think once we get past the pandemic, I think that's when we'll start to focus on that those more meaningful shifts.
I have another question, and I'm very aware of the time as well as we're coming up to towards 11:30. But a question was, from your point of view, how will tapering affect the recovery of Vietnam's economy in general, and the money market of Vietnam in particular?
I don't expect tapering to have much impact on Vietnam at all. I think one of the reasons behind that is, at the moment, in terms of foreign investor, and I'm talking about asset managers or portfolio managers, there's very, very low international foreign investor participation in Vietnam's asset markets. Foreign ownership of Vietnam equities is pretty low, very, very low for Vietnam bonds. That's really the main channel that we tend to see volatility in other markets, where foreigners own a high proportion of the bond or equity market, and Fed tapering comes along and foreign investors get spooked and they sell. And that's what causes the volatility. I don't see that as a risk at all for Vietnam. And with SPV now having ample reserves, and the Vietnam economy is still very much, once it fully recovers, I think it's going to be in a good position to withstand Fed tapering.
Excellent. So Khoon, I have to thank you again for a fantastic presentation, and I'm always honoured to speak with people who know a lot more about an industry or a subject than myself, because it gives me the ability to learn. And I have today. I've learned a lot about the future economy of Vietnam and also for the region. And I'd like to thank ANZ for making this possible, and for you giving us your time today as well. So basically, with the presentation, we're happy to share the presentation post this event, and also there will be a video which will be uploaded to our YouTube channel, and you'll be able to find on our Facebook channel, which is live now as well. But for the rest of the day, I hope that you have a fantastic day, both Khoon Go and also our attendees today, which has been a very large audience. And I wish you the best, and hope that you stay safe and stay strong, and that we meet again face to face soon, very, very soon. Thank you.